Why do firms need to adjust their books at the end of the period? In this video, I explain what adjusting entries are, why they're needed under accrual accounting, and how they impact the financial statements. Let's start with a refresher of when various balance sheet and income statement items actually get recorded under accrual accounting. Assets are recorded when the company obtains those resources. Liabilities are recorded when economic events or transactions generate an obligation to an outsider of the firm. Revenues are recorded when the company does its job, when goods or services are delivered to the customers. And expenses are recorded when costs are incurred that helped to run the business, that helped to generate revenue. Notice what is missing here. It's the timing of cash. And that's because the goal of accrual accounting is to record economic transactions and events as they occur, regardless of whether the cash exchange happens at the same time, precedes it, or follows it. And we already saw multiple examples of situations where revenues and expenses are recorded before or after the recognition of cash, and that leads to assets and liabilities recognized on the balance sheet. In this video, we're going to continue this line of thinking, but we're going to focus a little bit more on what the firm does at the end of the period. Because current required reporting is at the quarterly basis, I'm going to say that the end of the period is the end of the quarter. So what does the firm actually do throughout the accounting cycle? There is a multitude of transactions that company record as they happen throughout the period. For each transactions, they understand it, they document it, they record it with a journal entry into the general journal. That needs to also update the ledger. It previously used to be done by hand. Now everything is automatic. And that brings companies to the end of the quarter. At the end of the quarter, they do a little bit of bookkeeping, which we're going to skip. They prepare the trial balance. And then they have to make corrections, which is if they found any errors, and something that is of interest to us for this video, which are the adjusting entries. Now, before preparing the financial statements, a company has to ask ourselves, are we sure that all of our balances are accurate? Is every revenue that should be recorded recorded? Is every expense that should be recorded correspondingly recorded? Do we have any assets or liabilities that have changed during the period that we have not yet recorded? Now, all of the external transactions were probably recorded as they happened because companies were naturally keeping track of them and entering them into the system. But there are internal transactions that oftentimes are just driven by passage of time, kind of overtime usage of assets, overtime accumulation of liabilities that need to be recorded as a catch up at the end of the period, and we do them with adjusting entries. A couple of the patterns of adjusting entries that we're going to see. First of all of the adjusting entries are going to impact both a balance sheet and an income statement accounts. Okay, so we're not going to see any adjusting entries that only adjust the balance sheet. All of them do it via adjusting the income statement account as well. They never involve cash because if something involves cash, automatically it should have been recorded as it happens. That cannot be a transaction that just waits until the end of the quarter to be recorded. And they also do not result from an exchange with another entity. These are reserved more for just internal catch up and evaluation of whether anything needs to be updated on the financial statements. Let's talk about accruals first. Accruals are the transactions where the income statement recognition happens before an exchange of cash. We already saw some externally driven transactions, which are accruals. For example, you do a sales to a customer that generates an accounts receivable. They're going to pay you later with that accounts receivable. We're going to follow the same logic, but we're going to think about transactions that are a little bit more subtle, that might take a little bit more nuance for the companies to make sure that they're tracking them. For these transactions, the adjusting entry will record the revenue that is currently missing from the income statement. So something happened during the quarter where it satisfies the condition that the company did the work and gets to record the revenue, and we must make sure that we enter that in. Here's an example. We have an owner of a truck that rents it out for $4,000 annually. The payment is going to take place at year end. So each quarter they recognize revenue for the service provided. The service being we have allowed to have someone else access to our truck. So each quarter revenue will be recognized for $1,000 and accounts receivable will go up $1,000 as well. Is this any different from a situation that we saw where a company did a sale on credit? Not really. The only thing a little bit more nuanced here is that when you do a sale, when you hand the goods over, that is an external transaction that you know that this needs to be recorded. Here, the customer took possession of the truck in the very beginning of the quarter, and we have done our job, not by anything specific, but just by a sheer passage of time. We have allowed to have customer access to a truck for 3 months. We now need to make sure that we record that this passage of time drives the fact that we get to recognize revenue. In the future, at the end of the year, after all 4 quarters, the company will record the receipt of cash. So at year end, the truck owner collects the money and the accounts receivable will go away and the cash will be collected. So let's put all 4 quarters in line just to make sure that we're all on the same page. When the customer actually takes possession of the truck in the very beginning of the first quarter, nothing gets recorded because at that point in time, nothing really has changed. But at the end of the first quarter, we have allowed them to have possession of our truck for 3 months. So we get to record revenue of $1,000 and increase accounts receivable. We do the same adjusting entry at the end of the second quarter and at the end of the third quarter. Again, driven just by the passage of time, we have to make sure we remember, oh yes, our truck is still out there with the customer. By allowing them to have access, we have earned an additional quarter of revenue. So we do that. And at the end of the fourth quarter, we record the last piece of revenue, $1,000. But immediately, let's say we also collect the cash from the customer. So the cash is coming in and the accounts receivable that has been growing with adjusting entries for 4 quarters now gets wiped out and goes away. Again, the nature of the transaction is no different from other accruals that we have seen where revenue gets recorded and accounts receivable gets generated. It just doesn't occur in the middle of the quarter because boom, it kind of explicitly stares us in the face and we need to record it. It's a little more subtle. We get to the end of the quarter, we say, yes, we have to make sure we record it, and we do it. Let's talk about accruals where the expense actually precedes the cash payment. And again, it's going to be the same logic. We need to make sure that we check whether there are any expenses that are currently missing from our income statement that need to be recorded at the end of the quarter. Let's do an example where a firm promises year-end bonuses to their workforce and they estimate that the total bonuses will be $40,000. The firm is going to each quarter recognize the expense as the employees render the services and earn that bonus. So each quarter, the company is going to do a bonus expense and it's just going to be lumped together with other employee-related expenses. And they're going to create a bonus payable for $10,000. Again, they're doing it because they get to the end of the quarter and they say, okay, we've dealt with all of the obvious transactions. We have their salaries as we pay them with the paychecks. We make contributions maybe to their 401k. That was a cash transaction that triggered immediate recognition. But don't forget that one of the other things that happened during the quarter is that these employees, by their nature of providing us their services, have earned a bonus that they're going to receive at the end of the year. So we need to make sure we recognize this like any other employee expense. And at the end of the year, when the company actually pays the bonus, we will have cash going out as well as the reduction of all of those bonus payables that have accumulated. So just to put it out as all 4 quarters, what the company does is every quarter they will make the adjusting entry that reflects that the people are working for them and earning this bonus. The bonus payable will continuously go up, and then they will make a payment, so the liability will go down and the cash goes away as well. This is no different from other accruals of expenses where we have an expense that we haven't paid yet, so we create some kind of a accrued expense or a payable. The only difference here is that there was no explicit transaction during the middle of the quarter that says, we need to make sure we record a bonus expense. Instead, it was more about keeping track at the end of the quarter whether there's any other promises that we're making to our workforce as they're working for us that need to be reflected as an expense. Now, a natural question here is, bonuses are funny. What if we promise the bonus, but then we don't pay the bonus? So in this simple example, I'm assuming that the company can estimate this very well, and there's a high degree of certainty. If it was very uncertain whether or not the bonus is going to be paid, there actually would not be making this specific entry. And similarly, if throughout the year they realize the bonus amount is not going to be 40,000, it's going to be something bigger or smaller, they would adjust the numbers. But for now, we're keeping it simple. I'm assuming that the bonus was very predictable. There's high degree of certainty, and the reality actually matched to the expectations of the company. Let's talk about deferrals. These are our turtles where the cash exchange happens first and the income statement recognition follows. So let's start by talking about deferrals of revenue, the situation where we get the cash from the customer, but we haven't yet recorded the revenue because we didn't do the job. We already saw these deferrals of revenue in transactions that occur a normal part of business. Now we're just going to think of some examples where the companies would have to recognize them with an adjusting entry because they're not driven by anything specific in point in time. They're just driven by a passage of time. So here's an example. On January 1st, a customer pays to the gym a membership fee for the right to use the facilities. So on January 1st, when the customer makes the payment, the company receives cash and creates a deferred revenue, which is a liability. So that is an explicit transaction that happened that needs to be recorded. There's not going to be a delay in the recognition of that transaction. It hits the books when it happens. But then when does the revenue get to be recognized? When the gym does its job. What is the job of the gym? To remain open and allow customers to have access to that facility. So every quarter, the gym is going to recognize revenue just driven by the passage of time, that they remained open for 3 months. They have allowed their customers to have the opportunity to use the gym. Whether or not they actually use the gym is irrelevant. They will recognize 1/4 of the annual membership and reduce the liability by 1/4 as well. The cash transaction is going to be first. It happens on January 1st. And then at the end of every quarter, there's going to be an adjusting entry that the company says, let's not forget that we need to record revenue because of the passage of time, because we've remained open and did our job. And correspondingly, the liability goes away. At the end of the year, all of the revenue would have been recorded. Let's talk about the flip side, the situation where the cash outflow already happened, but because we did not recognize the benefit of that outflow immediately, it first sits as an asset on the balance sheet, and then as we use it up over time, we're going to recognize the expense associated with the usage of that asset. So here's an example of a cash transaction. A tenant prepays $10,000 of building rent for the full year on January 1st. I'm thinking about this from the perspective of the tenant. The cash goes down, but what the tenant receives in return is an asset called prepaid expense. I can also call it prepaid rent or prepaid asset. So they receive the right to occupy the building for the next 4 quarters. Now, when do they use the asset up? As they actually occupy the building. So each quarter, the tenant has to reflect that they have a rent expense, that they have used up a piece of the asset, and they no longer have 12 months remaining. They only have 9 months, 6 months, 3 months, etc. Putting it in one timeline, we can see that on January 1st, we have created an asset that was a cash transaction recorded as soon as it happens. But then every quarter, they're going to do an adjusting entry that reflects that they are slowly using up this asset just by sheer nature of occupying that building. That was a brief introduction to the accounting cycle and adjusting entries that companies must do at the end of the period. In the next video, I will apply this to Hartford Hot Sauce, and we will be able to finish out their first period as well as prepare their income statement and balance sheet. If you enjoyed this video, then please like, subscribe, share it with your colleagues and friends, and I'll see you in the next one.